Oh man, so the market is drifting slowly higher at the time of recording this video, but a few things are still weighing on the economy, namely inflation and of course tomorrow's key CPI reading. So let's take a look at what's going on in the markets. You can see at the time of recording, with 5 hours left before the market closes, we've got the S&P barely negative. You've got the same for the Dow and Nasdaq 0.2% down. Russell slightly up, and oil, of course, still rocketing higher. And what you can see here is a few other stocks, stocks are kind of generally drifting higher, but the stocks that are actually moving, similar to what we discussed yesterday, are these renewable plays. Look at this, 5% move on SunPower, Solar Edge up 7%, Enphase up 5%, which makes up a big part of my portfolio. First Solar 4%, Canadian Solar 4%, a big percentage of them. You've got Blink charging for the EV charging space. You then got Lucid moving. You've got EHang moving. So it makes sense. You've got Tesla up another 0.6% today. EVgo moving. So you can see the theme. It's around renewables, given the supply chain and energy crises we're seeing globally right now. Now, the IMF cut their global GDP forecast by 0.1%, which is very interesting for this year, although they kept it the same for next year. So that's 5.9% they're expecting expansion this year and 4.9% in 2022. And they're citing the supply chain shortages again as the rationale for that. So that brings us on to the CPI reading, which we're going to receive tomorrow. Okay, so tomorrow we're going to receive on October 13th. Tomorrow we're going to receive the reading for September's CPI. And this is the report from the previous month. And I just wanted to recap kind of what we've seen so far and what the different scenarios could be tomorrow and how that will pan out. So if we remember, we've kind of had some normal growth here. And then what we saw here was in 2021, March time, we started seeing some, significant month-on-month increases in CPI. Remember, all of these months are suggesting an increase, but it's the rate of change that the market is concerned about, okay? So a 0.6% increase in March meant that if you annualize that, that's a 7.2% annual inflation rate, which is very high indeed. And then when you saw the 0.8, that was even higher. And then in June, we saw the highest at 0.9. And in June, our total reading, as you can see, was about off the top of my head, 5.2, 5.3. Now, what we've seen is that slightly cooled down in July and August. We got a 0.5 month-on-month in July. Last month's reading came in at 0.3. And you can see we were creating a bit of a turning point, okay? So the differential has really come down, and we're almost, if you look at it, less food and energy, which is this reading here, this less food and energy is this maroon color here, you can see it's starting to point downwards, okay? So we've got this bit of a turning point, and that's why tomorrow's report is really crucial. Do we see a dot come in here? And for the blue line, do we see it here? Or do we suddenly get another go back here. Or do we see another 0.6 up here, 0.7, or God forbid a 0.9, which will send this back up? Because that's what we've been seeing in certain key commodities, okay? So that's what the market is going to be concerned about. So let's take a look at the Mannheim Index. So this is the index for used cars, which gives you a gauge of inflation for used cars. And you can see that we thought we had this top, right? And it came down. Everybody thought, okay, this is the way down now. We got a sudden decline and used car prices will start to go down. But now look at this latest reading we received. It suddenly jumped straight back up again. So this is a worrying sign here. This inflection point straight back up is a worrying sign. And will we see that materialize? Let's also take a look at lumber prices. Okay, so this is the LBS ticker for lumber, and if we start here with my mouse in 2021, so this is January 2021, we saw an increase, it came back down, and then we saw this massive run up through that we're in March there, and then May, still saw it start to trickle down through August, and then what we've seen here is we got to a low here in August, right? So 18th of August. But now, if I move my mouse, if this previous button will move out of the way, you will see we've inflected back up. Let me just switch over to the yearly. You will see we've started to head back up here in October, which is concerning because you thought this was going to come down, but we've seen us go back up. And that's what the worrying sign is here. Are we going to see that across the inflation reading overall? Now, What will this mean for the markets, right? If we get a heated inflation figure, if inflation comes in higher than we expected, if it doesn't start to really create that bend in that curve that I showed you to really start heading down, the market could see that as the economy heating up. Now, we've discussed this plenty of times before. High inflation means you erode the impact of your bond purchases, right? Your coupons that you're receiving. So we can see yields start to rise because yields are inversely correlated to your prices of your bonds. So if less people want bonds, the yields will go up. So we've currently seen, let's take a look at where the bond prices are showing at the time of recording. So you can see bonds are sitting at 1.607. It's just refreshed, 1.607. And that gives you an indication of where we're at now. It's quite high up. We've kind of, if I move me out the way, you can see we've kind of flicked back up. We're ahead of our simple moving average here. So it's definitely climbed up from what we had as 1.3 just in September. So yields have started to climb up because the market has started to understand that we may be seeing less transitory and more persistent inflation. Okay, so again, your yields will go up on your bonds, but also expect that growth stocks will take a hit, right? Because growth stocks find it harder to raise money in a high inflation environment because interest rates are more likely to go up, and growth companies require more funding than cash heavy companies who have proven profitability, right? So you often see that rotation away from growth into more value plays, which we've discussed a lot on this channel. So that's one thing to be concerned about. Now, the other thing we want to be looking at is if inflation comes in lower than expected, then what we could see is an announcement. Sorry, if it continues to come in higher, then we could see an announcement of tapering because we had a weaker jobs figure. Now, actually, let's go back a step. So Jerome Powell said if we see a moderately good jobs figure, he's pretty much prepared to announce the taper. But the jobs figure came in a bit weaker. So this gives him an escape clause to undo that promise of tapering. So he could say, no, the jobs figure wasn't good enough. We're not starting tapering just yet. And the market's pretty split on which way he's going to go about it. But this CPI reading, if it comes in hot, right, if it comes in higher than expected, this could then be the excuse for him to say, yep, we're good to go. We've got a weak jobs figure, but you can see inflation is ramping higher. We need to do something from a tapering perspective. Now, my concern here is just thinking this through. My concern here is tapering is a demand side way of reducing a heating up economy, right? So a heating up economy means we're seeing inflation. Now, monetary policy is saying, look, we can increase interest rates, or in this case, reduce tapering, reduce the amount of money we're throwing at the system. That should hopefully reduce demand, which should bring prices down. But the problem is this is not a demand-led inflation. This persistent inflation we're seeing is actually supply chain-led. And that's where the difference is. And that's where, people are starting to become a bit confused with how Jerome Powell is tackling this and whether it will have the desired outcome. So that's something for us to look out closely. Now, if we see inflation come down rapidly, then we could be seeing that the markets will probably react positively to that. We should see growth stocks up, we should see yields come down, and that should be a positive for the market. So we have to wait to see what happens with that. Now, the other factor worth considering in all of this is Bitcoin. So we know that Bitcoin moves in a correlation to inflation. It's seen as a hedge against inflation, and therefore, if we see higher CPI readings, in theory, you would see a higher Bitcoin price. Now, obviously, there are many other factors moving the Bitcoin price, and it's an extremely volatile asset class, so it's not as straightforward as that. But what I tried to do was I tried to illustrate the last few CPI readings and take a look at how this affects our CPI Bitcoin price. So let's take a look at this. Let me move that out of the way. And what I've done is you can see I've put the first reading here. So we got a reading on the 10th of June, which was the May reading. And that was a 0.6 month-on-month growth in our CPI, okay, the May reading. So that May reading was 0.6 month-on-month growth, and it was a cooling off from the April reading, okay? So that was seen as inflation not being so high. So we should expect the Bitcoin price to fall somewhat, and we did see that, okay? So we saw that kind of suddenly go up and then realize, okay, this is actually cooled down from the previous month, and Bitcoin did go down. The next month, we saw a very high reading of 0.9, and we saw Bitcoin moved in relation to that. The next reading came in at 0.5, so not as high as the 0.9, settled down, but it's still high inflation, right? That's still a 6% per annum inflation, and Bitcoin moved up in relation to that. And then the month after, when we got a 0.3 reading, which is what we've just seen, that really gave us the impression that things were starting to cool off, right? We're seeing this turning point, and that's why we expected Bitcoin to fall, and it did fall in relation to that. Now, since then, we've had our massive pump coming off the bottom of the wedge, which we've been covering, but you can see there is a decent amount of correlation with the inflation reading. So I expect the same tomorrow. Perhaps we could get a little of a catalyst here, either side. I mean, if inflation comes in nice and high, this could continue to help Bitcoin move through the 60,000 mark, but vice versa. If we see a weaker inflation, then maybe that could be a reason for Bitcoin to kind of correct a little bit, a couple of percent, maybe come back down, test 54, 55 sort of levels, because obviously it moves in tandem with inflation. So there we have it, guys. There's an update on what we are seeing in the market right now. I mean, normally any day before you get a big reading, the market does, kind of just drift. Traders and institutions don't want to place heavy risk right now. They kind of want to wait and see, and markets hate uncertainty. So when news comes out, like the CPI reading tomorrow, markets will be waiting, and when the reading comes out, they'll be making their moves. And again, if we see inflation to the high side, which means the economy is heating up, that may be the catalyst Jerome Powell finally needs to announce a taper. Remember, the Fed are meeting on the 2nd and 3rd of November, which is about 2 weeks from now. So they'll be able to give us their decision on whether we're going to get a November taper or if they're going to delay it to December or even later. Now, remember, Jerome Powell also has the optionality to play around with the speed of the taper, which a lot of people aren't talking about, okay? So one thing is about when does he start taper? The other is about how aggressively or how gently he starts taper. So he may have already decided in his head he wants to start a taper from November all the way into June or July. But if inflation continues to come in hot and persistent, he may say, I'm going to start off more aggressively with my tapering and not do it in equal increments, but do it really front loaded, right? So November, December, January, February, really go aggressive on the taper and then get gentler as the amount that they're buying in terms of 100 billion of assets they're buying a month really tapers down quickly. So that's another thing to note, which Jerome Powell could pull out of his sleeve. So there you go, guys. We'll be watching the CPI reading tomorrow very closely, hoping for that to come to the downside. But the evidence around lumber, the Mannheim Index, and various other commodities, including oil, which we didn't cover just now, are showing a multi-year highs and showing that the inflection point down didn't really happen. We've seen a bounce back up, and that, along with what we saw in terms of earnings inflation, because wages are going up, may be a sign that inflation might come in a little bit higher than we were expecting tomorrow. And then it's over to Jerome Powell to see what move does he want to play next. If you like my perspective, guys, then please don't forget to hit the like button and subscribe, and I will see you in the next one.